SPACs have come under a lot of scrutiny recently, with downwards pressure hitting the stock prices in a very big way. In the past 2 weeks, SPACs are down 20% versus the market indices, the S&P 500's decline of only 0.82%. This is more than expected given the volatile nature of these instruments. Put simply, when a market sells off, rebalances, rotates to value, whatever you want to call it, these types of instruments fall faster and further than the rest of the market or the market average. However, it's also true that they tend to rise a lot quicker than the market average in an environment where everyone is bullish. Yes, this is because they have relatively low float, and so buying and selling shares moves the price sporadically than higher float instruments. Also, though, a lot of the time people buy and sell for reasons that are unrelated to the underlying business, which also makes for volatility. But in many cases, it rises quickly because you have a young growing company that underlies that SPAC, which gets a lot of people excited. However, in many cases, they're pitching a story more than concrete or convincing numbers, and it falls quickly for that exact reason. And because there's a higher degree of uncertainty around how these stories will actually play out. Take Nikola as a prime example. Great idea, lots of potential, huge growth expectations, but wait, no product, no revenues, and no real credible investors with their neck on the line. I don't need to go into too much detail with Nikola, but we all know how that one played out. If we take all of the SPACs from the past year and predict their future, a lot will be a complete flop. But to be honest, the majority of IPOs don't live up to initial expectations either. So my thesis is some of these are going to be real winners. And this is because there is a real business transaction going on here. You are purchasing warrants to ownership of a business, and once that transaction completes, the ownership is no longer a warrant, but a real share of that company's revenues, profits, assets, etc. Quite frankly, the way you should assess SPACs is no different than how you should approach any investment. Apart from the due diligence you do on the people working on the transaction and the profile of investors who are involved, everything is as usual. How productive is that business going to be over the next 5 to 10 years? Does it have favorable economics? Can it reach profitability? How quickly can it reach profitability? And with little stress on the balance sheet? What are the likely stream of cash flows that we will receive as owners of this business? And however, many other questions that you can explore. And with that in mind, I want to share with you 2 SPACs that I decided to buy the dip on last week. I already own both and have given strong investment cases for both on this channel and on my Patreon page. But here, I want to reinforce those cases with more facts and figures than just stories. You'll probably not be surprised to hear that they are Proterra and SoFi, trading under ACTC and IPOE as SPACs until the deal closes in the next month or so. In my opinion, it's no surprise that even after the drop, these are the best performing SPACs or pipes that the serial SPACer Chamath has been a part of. That's because they are the highest quality businesses with the most convincing growth stories and numbers that sit beneath the SPAC instrument itself. SoFi, in terms of its huge addressable market and the fact it operates within what is historically a very luxurious industry in terms of profitability and scale, it has real revenues and proven products as well as profit visibility in just the next year or so. It also has a suite of best-in-class products that will enable meaningful growth for a long period of time. They only need a very small capture of this huge market and to appeal to only a segment of this market to be a major success story for the next 5 to 10 years. And I feel they have the ability to do that. As for ACTC, well, they have some very strong tailwinds that will lift the numbers very significantly, even in the short term. For instance, the majority of their revenue up until 2022 to 2023 is made up of $700 million of sales contracts or backlog that have already been signed and placed by Proterra's customers. If that's not clear visibility, I don't know what is. There's also the fact they dominate the North American EV bus market that is being forced to grow at a rate of 50% per year for the next 5 years. Yes, forced due to government state-imposed regulations around zero-emission fleets. This is evident in the recent deals that they've been able to put together as well. They have 50% market share, which is expected to grow given their superiority to others in terms of product, speed, and reliability. They also have 2 other segments of the business that will benefit from very similar tailwinds. Plus, in summary, both of these companies contribute to improved social good and well-being, which is a major positive and will help them with an easier route to success. Now, I recently remodeled both Proterra and SoFi for my Patreons on the Patreon page, coming up with a distribution of scenarios for both companies' 5-year future. This allowed us to assess the potential downside with each company. Why? Not because my conviction or confidence in them has dropped, but rather to see who is or are the best candidates to buy more of if the downside is low, but also to demonstrate that the most important thing is the underlying business's results regardless of the near-term volatility. So these measured 4 quartiles of performance. You've got bottom quartile, lower middle, upper middle, and top quartile. Top quartile being their own projections that they gave us in their investor presentations. So in terms of my remodeling and scenario analysis for both of these stocks, I gave a narrative or summary of assumptions to go with each scenario. So feel free to pause if you want to see that. But for ACTC, all but the bottom quartile modeled ACTC stock is undervalued, still using a 15% discount rate as well. So no fiddling the price to account for low yields or low interest rates. No, we maintain our required rate of return, which is 15%. And that means that when the market panics, because interest rates rise and they valued it using a cost of capital structure or risk-free rate method, we can pretty much sit tight. Don't get me wrong, the stock market will be volatile, the prices will fluctuate, but we know that we don't need to change our valuation too much, except for maybe reassess a terminal value multiple. And to just scan over the other scenarios, the main adjustments were to do with growth, margins, or market multiples, which are the core factors to consider, especially if we're worried about valuations due to rising rates. Bottom quartile showed ACTC indicating a 9% compound annual return, even though it's slightly overvalued using our 15% discount rate, but 9% is not bad. Lower middle indicated ACTC was at fair value or slightly undervalued, implying a 15% plus compound annual return. Upper middle indicated ACTC was 44% undervalued, and the top, being their own estimates, showed the stock to be 145% undervalued, implying a 33% compound annual return from the stock price on Friday at close. As for SoFi, well, that came out looking pretty solid too, with 4 scenarios that estimated quite severe underperformance versus their own projections, and still came out with a likely 8 to 9% return for the bottom quartile, matching maybe the market. And the lower mid quartile suggested 12.5% return, which is slightly overvalued using our 15% rate, but it's still beating the market. Upper middle quartile suggested SoFi was 10% undervalued and implied an 18% or more compound annual return. And then the top quartile, again being their own projections, indicated IPOE was almost 50% undervalued with a 23% compound annual return. Not bad at all, considering the bottom end of all the realistic scenarios shows that you'll pretty much match the market at worst. And that hints to me at lowish downside and high upside, which is what I like to invest in. Now, I'm not saying that the bottom quartile in each case is the worst possible outcome for either of these businesses. Far from it. But I wanted to keep it realistic in the sense that unless each company has an unforeseen event, which we wouldn't be able to account for anyway because no one can see them coming, they will grow. These are high quality businesses with good management and disruptive and in-demand products. And as I said, I've given a narrative around each quartile that explains what could be the cause of this underperformance or the likely cause, and you can check that out on the Patreon page. If you would like access to these models so you can amend any of the assumptions and assess your own version of the downside or upside in either of these stocks or many more stocks that we've covered on this channel, you can do so by joining the Patreon. You basically get 1 month free trial. You don't incur any fee until April if you join in March. So it's also available to cancel at any time as well. So it's basically like a month free trial. And we're up to 14 Patreons in just a few days, which is amazing. And I appreciate everyone who has joined and supports the channel already. I plan to make a real like-minded investment community out of it very soon with Discord benefits, hopefully, and many more benefits that are already part of the package going into the future. That's all for this video, guys. I hope you enjoyed it. If you did, leave a thumbs up. It really helps with the YouTube algorithm and everything like that, and getting the channel out to more like-minded people like yourself. Subscribe to the channel if you haven't already. I'll be posting many more videos just like this one and on other topics as well. I will see you in the next video, guys. Good luck with all of your investments.